Hey there! In this video, we'll walk through key real estate math formulas that you absolutely need to know for the exam. Grab a notebook and a calculator so you can practice like it's exam day. Let's start with the first 10.
LexaWise, Real Estate Exam Prep.
Formula 1 is total commission equals sales price times commission rate. This formula is used by real estate agents to calculate how much commission they will earn from the sale. Now, with that formula, try to figure out this situation. A property was sold for $250,000 with a sales commission rate of 6%. The buyer's broker received 45%, and the listing broker received 55% of the total commission. If the listing broker kept 70% and gave the other 30% to their salesperson, how much would the salesperson receive? A. $4,725. B. $5,775. C. $2,475. D. $2,025. Let's break this down step by step so it's easy to follow. First, we know the total commission on the property sale is 6% of the sale price, which is $250,000. So we calculate $250,000 times 6% equals $15,000. Now the listing broker gets 55% of that total commission. So we multiply $15,000 by 55%, which gives us $8,250. Out of this $8,250, the listing broker keeps the 70% and gives the remaining 30% to the salesperson. So we calculate $8,250 times 30% equals $2,475. So in the end, the salesperson would receive $2,475. So the correct answer is C. Did you get it? Let's move into the second formula. Capitalization rate equals net operating income divided by market value times 100. In real estate, capitalization is the process of converting income into property value. Meanwhile, net operating income, or NOI, calculates how profitable a real estate investment can be. If you are interested in learning more about this or other terms, you should check our math guide. Anyway, investors use this formula to assess the profitability of rental properties or commercial buildings by comparing income to property value. Now that we know about the formula, let's see it in an exam-like question from our database. A building in downtown has a market value of $270,000, and it is currently generating a rental income of $1,700 per month. How much is the capitalization rate on this building, given that the property tax rate is 0.95% per annum? A. 5%, B. 7.55%, C. 6%, D. 6.61%. All right, let's go through this step by step in a simple way. First, to find the annual rental income, we multiply the monthly rental income by 12, since there are 12 months in a year. $1,700 times 12 equals $20,400. Next, we calculate the annual NOI, net operating income. To do this, we subtract the annual property tax from the annual rental income. The property tax is 0.95% of the property's market value, which is $270,000. So, we first calculate the tax. $270,000 times 0.95% equals $2,565. Now, we subtract that from the annual rental income. $20,400 minus $2,565 equals $17,835. So, the annual NOI is $17,835. Finally, to calculate the capitalization rate, we divide the annual NOI by the market value of the property. So, $17,835 divided by $270,000 equals 0.0661, which is 6.61% when expressed as a percentage. And there you have it. The capitalization rate is 6.61%. The result is 6.61%. So the right answer is option D. The following formula is maximum loan amount equals appraised value times LTV ratio. Lenders use this formula to determine how much money they are willing to loan for a property purchase. Try solving this problem now. If a property is appraised at $400,000 and the bank requires an 80% loan to value ratio, how much is the maximum loan amount the bank will provide? Which one would you say is the right answer? A. $80,000. B. $240,000. C. $320,000. D. $400,000. To calculate the maximum loan amount, you can multiply 400,000, the appraised value, by the loan to value ratio as a decimal. In this case, 80% as a decimal is 0.80. That is $320,000. So the maximum loan amount would be the option C, $320,000. Coming up with the next formula, down payment equals purchase price times down payment percentage. A down payment is the upfront cash a buyer pays when purchasing a home. It's a percentage of the total price, and the rest is covered by a mortgage. Can you solve this practice question? If a property sells for $300,000 and the buyer puts down a 20% down payment, how much is the down payment? A. $30,000. B. $60,000. C. $240,000. D. $270,000. To calculate the down payment, you can multiply the purchase price by the down payment percentage as a decimal. In this case, 20% as a decimal is 0.20. So the down payment would be $60,000. The answer is B. Next, transfer tax equals sale price divided by tax unit times rate per unit. This is often used by closing agents or title companies to calculate the tax due during a property transfer. Tax unit is the value the tax is charged per, like $500 or $1,000. And the rate per unit is the dollar amount charged per that unit, like 50 cents per $500. See if you can solve this question. What would be the amount a grantor needs to pay for a $75,000 sale, considering transfer taxes are charged at a rate of 50 cents per $500? A. $75. B. $7.50. C. $750. D. $7,500. This problem is asking you to figure out the role of the grantor in a real estate transaction. A grantor is simply the person who is transferring ownership of the property, usually the seller. Think about it. To calculate the grantor's cost for the $75,000 sale, considering transfer taxes at a rate of 50 cents per $500, you would need to determine how many $500 increments are in the sale price and then multiply that by the transfer tax rate. Then, to find the number of $500 increments in a sale price, you divide the sale price by $500. In this case, the sale price is $75,000. So you simply divide $75,000 by $500. This gives you 150, meaning there are 150 increments of $500 in the total sale price. And to finish, calculate the transfer tax. You multiply the number of increments by the rate per increment. In this case, we have 150 increments, and the rate per increment is 50 cents. So you multiply 150 by 50 cents, which equals $75. This is the total transfer tax. The grantor would need to pay $75 for the transfer taxes on the $75,000 sale. The correct choice is A. Transfer tax rules vary by state and sometimes by county/city. Always confirm the tax unit, rate format, and any rounding rule for your testing jurisdiction before exam day. Let's keep going. The following formula is total sale price equals area times price per square foot. Real estate professionals use this when calculating the total value of properties, especially when working with commercial or residential properties that are priced based on size. Let's see the practice question. When selling a property measuring 138 feet by 100 feet at a rate of $3.20 per square foot, and considering a broker's commission of 5%, what is the amount the owner receives from the transaction? A. $419,520. B. $41,952. C. $13,110. D. $44,160. Take your time. To know the amount the owner receives at the end, we need to know the total sale price first. To calculate the area of a property, we multiply the length by the width. For example, If the length is 138 feet and the width is 100 feet, the area is 13,800 square feet. Next, to determine the total sale price, we multiply the area by the price per square foot. If the price per square foot is $3.20, the total sale price is 13,800 square feet times $3.20 equals $44,160. Now, we need to calculate the broker's commission. If the commission is 5%, we multiply the total sale price by 0.05. So $44,160 times 0.05 equals $2,208. This commission amount is then subtracted from the total sale price to find the owner's amount. So $44,160 minus $2,208 equals $41,952. The answer is B. Let's move on. The next formula is GRM equals property value divided by annual rental income. Investors use GRM to quickly evaluate whether a rental property is a good investment based on its income potential. This is the question to practice this math formula. Don't give up. We're almost at the end of this video. What would be the gross rent multiplier for a property valued at $580,000 given a monthly income of $5,200? A. 9.50, B. 8.62, C. 93.00, D. 9.29. Let me break this down for you. First, to calculate the annual gross income, which is the total income generated from renting the property in a year, you multiply the monthly gross income by 12, since there are 12 months in a year. So, if the monthly income is $5,200, you multiply that by 12. That is $62,400. Now, we use this to calculate the gross rent multiplier, GRM, which helps determine the value of a property based on its rental income. To find the GRM, you divide the property value by the annual gross income. The gross rent multiplier for the property valued at $580,000 with an annual gross income of $62,400 would be approximately 9.29. So the right answer is D. Next formula, daily tax rate equals annual tax bill divided by the number of days in the year. This is used when calculating prorated property taxes during a closing, especially for multi-party transactions or when property taxes are due at the time of sale. Here is a practice question. Assuming a banker's statutory year of 360 days, calculate the prorated taxes to be debited to the seller or credited to the buyer for a June 14th closing if the taxes for the property have been paid until the end of the previous year. The annual tax bill for the property is $4,725, and the proration will be done up to the day of closing. A. $2,123, B. $2,362.50, C. $2,152.50, D. $1,758.75. Time to pick an answer. The daily tax rate equals annual tax bill divided by 360 days. We use 360 days because the problem specifies a banker's statutory year. If it had stated a calendar year, we would divide by 365 instead. So, daily tax rate equals $4,725 divided by 360 equals $13.125. The question says they've paid until the previous year. That means until December. So we have left January, February, March, April, and May. There are 30 days in each month, while in June there are 14 days. With that in mind, total days equals 30 plus 30 plus 30 plus 30 plus 30 plus 14 equals 164. Prorated taxes equals daily tax rate times total days. So the prorated taxes equal $13.125 times 164 equals $2,152.50. The correct answer is C. Next formula is current value equals original value times 100% plus the rate of appreciation. This formula helps us calculate the current value of an asset like land or property after it has appreciated over time. The rate of appreciation tells us how much the value of the asset has increased, usually given as a percentage. Here is a practice question. 7 years ago, Steve acquired a cabin for $48,000. And at that time, the value of the land it stood on was $8,700. Given an annual land appreciation rate of 4% and a cabin depreciation rate of 3%, what would be the current value of the land? A. $9,048. B. $10,654. C. $11,136. D. $6,264. To solve this, we need to calculate the appreciation of the land first. The formula is current value equals original value times 100% plus rate of appreciation. This formula works when there is one single period, usually 1 year. In real life, property values over several years often use compound appreciation, but the real estate exam keeps things simple. Unless the question clearly says compound, you should always assume simple appreciation and use this formula. That's why this is the correct approach here. With that cleared up, let's write down the information we're given. The original value of the land is $8,700. The rate of appreciation is 4% per year for 7 years. So we multiply 7 times 4%, which gives us 28%. Now let's plug everything into the formula. Current value equals $8,700 times 100% plus 28%, or $8,700 times 1.28. Current value equals $11,136. So the current value of the land is $11,136. The correct answer is C. Time to work with the last formula of this video. Equity equals fair market value minus mortgage balance. Equity is the value you actually own in a property. It's the difference between the home's market value and what you still owe on your mortgage. We'll apply this to a case. Jenny is a homeowner who has a mortgage balance of $215,000 on a property that is currently valued at $345,000. What is the equity in her property? A. $130,000. B. $145,000. C. $345,000. D. $560,000. Now it's time for the answer. To find the equity, we start with the current value of the property, which is $345,000, and subtract the remaining mortgage balance of $215,000. When we do that, $345,000 minus $215,000 gives us $130,000. So, Jenny has $130,000 in equity in her property. The correct answer is A, and there you have it. All right, we just walked through 10 of the 20 most common real estate math formulas you're going to see on your exam. Which formula gives you the most trouble right now? Let us know in the comments below. And if you didn't catch everything the first time, don't worry. With LexaWise's math guide and practice exams, you can put these new formulas to the test and sharpen your skills. If this video helped you, hit like, subscribe to the channel, and turn on notifications. Thanks for watching, and see you in the next lesson.